Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. Over the last couple of weeks, equity markets have fluctuated quite significantly as they come to terms with what life and the economy will be like after COVID, and what that will mean for key metrics such as interest rates, growth, and inflation. In the 3 weeks from the 19th of February through the 5th of March, the NASDAQ 100 index had a range of 1,671 points, or 12%. That's a significant degree of volatility in an index that has been at the forefront of the bull market over the last year. The NASDAQ wasn't alone either. The S&P 500 technology sector had a range of 10.5% during that period as well. Though technology and growth stocks finished those 3 weeks towards the lower end of their ranges, they did at least bounce from their lows, which could suggest that we have seen a correction rather than a crash. However, in that same period, the yield on 10-year U.S. Treasury bonds has risen by more than 1/3. This yield represents the implied cost of U.S. government borrowing and in turn helps to set a range of real-world interest rates in the U.S. economy. For example, 30-year mortgage rates rose above 3% last week for the first time in 7 months, having been at record lows as recently as January this year. What we have experienced in recent weeks may just be growing pains in the economy and an associated readjustment in the markets. But what if it's not? What if it's a sign that getting back to normal and reopening the economy could be every bit as volatile as shutting it down was? Well, in those circumstances, investors would look for safe havens, places to park their money securely whilst they wait for the storm to pass. There are several classic safe havens, including gold, U.S. government bonds, the Japanese yen, and defensive stock sectors such as utilities and consumer staples. However, these may not be the best bets at this time. The price of U.S. government bonds has been falling precisely because their yields have been rising. Defensive stocks, such as utilities, are often described as bond proxies, and their prices tend to move in line with each other. So, if government bond prices are falling, then so will the prices of these defensive stocks. And indeed, both the S&P 500 utilities and consumer staples sectors are down by -5% year to date. The prospect of higher interest rates generally has been helping the U.S. dollar. A stronger dollar is generally negative for gold prices, which are already down by more than -10% year to date. Of course, a stronger dollar also implies a weaker yen as part of the dollar-yen exchange rate. Indeed, the U.S. currency has rallied by 5% against the yen year to date. So, with many traditional safe havens seemingly off limits, or at least likely to underperform during any large correction in equity markets, are there any alternatives to selling and going into cash or sitting tight and trying to ride the storm? There's an old proverb that says nobody ever went bust taking a profit. And if you are sitting on good gains from this time last year, then it may be time to bank some or all of them. However, if you'd rather stay invested and look for new homes for your money, where might you find opportunities? Given that markets are anxious about the reopening of the economy, one place to look for a home for your money would be those sectors that should benefit from that reopening. One of the most obvious sectors to benefit is energy. Oil prices have been rising of late, driven by a continuation of production quotas from Saudi Arabia and Russia, which are limiting supply and the expectations of increasing demand over the next 18 to 24 months. Energy-focused ETFs have been among the best performers in the market year to date, with many posting double-digit percentage gains in the last week alone. Trackstar IQ, our proprietary search tracking tool, shows that over the past 7 days, the United States Oil Fund ETF received 33 searches from 29 institutional investors. ETFs with a focus on small and mid-cap stocks have also performed well so far in 2021. Small-cap companies are, by and large, businesses that will benefit from reopening, as should retailers and ETFs that are focused on those stocks. Another area that may provide shelter is value investing. Value strategies have been out of favor whilst technology stocks and growth strategies have been performing so well. However, with those themes now under pressure, this might be value's moment once more. It may even be right to combine a small and mid-cap focus with a value strategy, and ETFs that do just that have performed well in 2021 to date. It could well be a bumpy ride over the next few months, but the good news for retail investors is that they don't need to sit passively as the markets move sharply around them. That is because there are so many alternatives open to them thanks to the proliferation of ETFs that focus on specific sectors and trading strategies. This means you can switch tactics on the fly, and that's got to be a good thing. That's all we have time for this week. Before you make any investment decisions, please ensure you do your own due diligence. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.